All right, just one more minute and we'll get started. We have a lot to cover today, so we want to make sure to have plenty of time to go over information. Thank you, everyone that's here. All right, let's go ahead and get started. Welcome once again to everyone to a webinar on navigating federal student loan repayment, life after save, and avoiding default. My name is Jessica Manfredi. I am the student loan advocate within Washington State's Office of Student Loan Advocacy. Our panelists today include student loan advocates and ombudspersons from California, the District of Columbia, Illinois, Maryland, Massachusetts, Nevada, North Carolina, and Virginia. We are glad that you're here today to learn about this very important topic that is affecting millions of borrowers nationwide. Here are a couple of reminders for everyone that is attending today. In case you need it, Zoom has a closed caption option that you can activate at the bottom menu. So if you need that to be able to access the information today, make sure to take advantage of it. All participants are going to be muted throughout the presentation, and we don't have a chat or a Q&A available today due to the number of participants. However, this session will be recorded and posted on YouTube, and you will receive a YouTube link and a copy of the slides via email about a week after today. And you can, so that you can have the ability to review the materials or the presentation at your own pace. All of this information that we're going to be sharing today is updated as of today. But as you know, things change with student loans all the time. So the information may change in the future. So if you're watching this recording at a later time, just keep in mind that some of this information might be out of date. We have a lot of ground to cover, so I will go ahead and get started. Amber, next slide. So our agenda today is to first give you an overview of what is the SAFE plan. And then we're going to move on to talk about some overall strategies for you to manage your student loan debt. We'll then finally dig into what life after SAFE is going to look like as far as your options to manage your debt. And finally, we're going to end by giving you some detailed action steps that you can take to successfully manage your federal student loan debt as we transition away from the SAFE plan. Next. So what exactly is the SAFE plan? As most of you are here today, probably because you're enrolled into the SAFE plan, so you might already have some familiarity with it, but it's helpful for you to get a little bit more background about why it got started and why it's being taken away, right? So the SAFE plan is an income-driven repayment plan, so a plan that is based on your income. The SAVE stands for Saving on a Valuable Education. This plan is a modified version of what used to be the Repay plan and was updated during the Biden administration to allow for more affordable monthly payments and faster forgiveness for low balance borrowers. Borrowers that were in Repay were eventually automatically moved into SAVE in the summer of 2023. And currently, there are still about 7 million borrowers in the SAFE plan. And while the SAFE plan was a great option that was affordable for many borrowers, the plan faced strong opposition by attorney generals in several Republican states and has, as a result, effectively ended because of lawsuits. Next. So just to give you an idea of what the SAFE timeline has been, so you can better understand what has happened, while you have been in this plan in the past couple of years. In March and April of 2004, 11 state attorney generals sued the U.S. Department of Education over the SAFE plan. Then in June 2024, a court injunction paused the SAFE plan while the case was being heard, meaning your servicers were no longer able to send you bills, right, under the SAFE plan. And then in July of 2024, because of that injunction, borrowers were placed into a forbearance that is commonly known as the safe forbearance, that is interest free, right? So interest wasn't accumulating at that point in time. However, a year later, in August 1st of 2025, the Department of Education shifted stances and interest actually started accruing for folks that were in that safe forbearance. And finally, about 7 months later, on March 10, 2026, court rulings ended the SAFE plan once and for all. So this is kind of where we are right now. And while you may have already received several emails and other notifications from the Department of Education about the SAFE plan ending, it's important for you to know that you're also going to be receiving notices directly from your servicer that has some important deadlines. Starting July 1st of 2026, loan servicers will begin to issue 90-day notices requiring borrowers to switch to a different plan or be automatically placed on the standard plan. You will have 90 days to switch to another repayment plan. Because you don't want to miss this notice, you need to make sure that you keep your contact information up to date with your student loan servicer and on your studentaid.gov account. And you also want to make sure to check your accounts regularly for communications and or bills. These communications are often posted to inboxes in your servicer accounts. So that's why it's important to log in regularly and ensure that you don't miss any important announcements. Now that we have laid down the background information about SAFE and what notices you should be expecting in the next few months, I'll go ahead and pass it over to Scott Kemp so he can talk about strategies to manage your student loan debt.
All right, thank you, Jessica. Thank you for providing us that background. And so now we'd like to talk about what some of your options would be, what some of your strategies. And just keep in mind, there is no one approach that works for everyone. So we're going to give you several different options, and just our contact information will be at the end, so you can reach out by state for particular help that you may need. Next slide. So a big part of it is, what is your repayment goal? And I'm going to talk about the first two. They're talking about paying off your debt quickly and also looking at whether your goal is low monthly payments. Next slide. So obviously, anytime you have any kind of debt or loan, you want to pay it off in using the best approach possible for you. And one might be, to make your strategy to pay it off quickly is to make lump sum payments or pay more a month. And you might have heard in the past, like with mortgages, you make one extra payment a year and it can cut off 2 to 3 years off your mortgage. Well, the same goes for student loans. So you can either, maybe come across some money, you can make a lump sum payment, or, you can pay a little bit more each month. This is for borrowers who have low loan balances relative to their income. And if this is your goal, then you should choose either the current standard plan or the new tiered standard plan. Next slide. If your goal is low monthly payments, and this may be a strategy for someone who is working towards loan forgiveness, or maybe they're having some issues with having enough income to pay their bills, this strategy is the best option. And as I said, it's for those with low income, older borrowers who are looking at getting their loans discharged later on, or other borrowers who just can't realistically. And if you're choosing between paying your student loan and putting food on the table, obviously, you want to focus on taking care of your family and your needs. If this is your goal, you want to choose an income-driven repayment plan, and we're going to talk about some of those, or an extended repayment plan, which stretches it out over a longer period of time. And the new tiered standard plan, which is going into effect for new loans, it'll be an option starting July 1, does stretch it out over a longer period of time based on the amount of the loan. And with that, next slide, I'd like to head due south and pass it over to my colleague, Luke Perrin in North Carolina.
Thank you, Scott. Going to talk for a little bit now about your loan forgiveness options for your federal student loans. And really kind of the two main options that you're going to have for those loans are going to be income-driven repayment forgiveness and public service loan forgiveness plans. So under IDR plans, your payments are going to be based on your income, your family size, your tax filing status, and they're going to forgive the remaining balance of your loans after making a certain period of payments. With those income-driven repayment forgiveness, that's going to be anywhere from about 20 to 30 years, whereas public service loan forgiveness is going to forgive those after 10 years on that plan. Ultimately, if this is going to be your goal, you're going to want to choose one of those income-driven repayment plans. We'll talk more in a little bit about what those options are going to be. And your strategy here is going to be to make the minimum required monthly payments until you reach that forgiveness. There's really no incentive to make extra payments toward this because your goal is to have the most forgiven at the end of that term. Who is this for? This is going to be for somebody who has maybe like a low to a moderate income compared to their loan balance, somebody who's been in repayment for a long time, or specifically with public service loan forgiveness, somebody who is committed to working for a local, state, or federal government agency or a qualified nonprofit, and somebody that's really committed to staying in that sector because it's going to require you to make 120 payments while working at that institution for a full-time or an average of about 30 hours per week at that employer. Next slide. So you might actually even be closer to forgiveness than you think. So there was a temporary opportunity a few years ago called the payment count adjustment that some folks might have received for credit toward either your public service loan forgiveness or income-driven repayment forgiveness for a past period of repayment or certain periods of forbearance that normally wouldn't have qualified. And so keep that in mind when you're thinking about what your repayment goal might be. You can take a look at this by going to your studentaid.gov account. If you're enrolled in PSLF, you can view the PSLF payment progress on your account dashboard, or you can check out your income-based repayment plan or check out your IDR forgiveness term date on your IDR application on studentaid.gov as well. So just keep that in mind as you're maybe deciding which of these forgiveness plans might be best for you. Next slide. A few general tips as you're moving towards loan forgiveness. And again, I will just emphasize what Scott said a minute ago, that a lot of these are going to be very situational with some of the tips that we're going to talk about. And so ultimately, if you have specific questions about that, would advise you to reach out to somebody, reach out to a qualified tax professional. But some general tips here. First and foremost, to certify your employment every year if you're doing public service loan forgiveness by submitting a PSLF form. That's going to have some employer requirements as well. So making sure that you keep that certified so you can maintain good standing with the program. Track your PSLF progress very closely in your studentaid.gov account as well, so you have an accurate idea of those payments towards your 120 payments that you're working to. Look out for requests to recertify your IDR plans annually and consider opting into automatic recertification. I will note that if your income drops at any point, you should request recalculation of your payment right away at studentaid.gov. Since that's going to be based off of, like I mentioned, some factors earlier, including income, family size, tax filing status. Any change to your income is going to change how much your payments are. And so if your income drops, you're going to want to request that so you can have a lower monthly payment. And lastly, I mentioned it a second ago, but I'll say it again just to emphasize its importance. Don't make extra payments. The goal here is to get the most forgiveness possible. And any extra payments that you make is money that's not going to be forgiven later on. I will just also add here specifically that at a federal level, any of these things that I've talked about, those are going to be the forgiveness is going to be tax exempt. However, that's not going to be the case in every state. So if you have questions about your state tax, the state tax on your forgiven loans, would advise you to reach out to a tax professional to learn more about your specific situation. Next slide, please. There are a few we'll just say situation-based forgiveness options or discharge options that you could also look into that I just want to touch on briefly. The first is what we call total and permanent disability discharge. So if you're not able to work due to a disability or an ongoing medical condition, you may be able to have your federal student debt canceled or forgiven through total and permanent disability. TPD is the acronym. You don't have to be receiving Social Security disability benefits in order to qualify. And there are a few different ways to qualify, either through certification of disability through the SSA, through the VA, or through an eligible medical professional. The second thing I just want to emphasize here is this program called Borrower Defense to Repayment. This allows you to seek the discharge of your student loan debt if the school violates certain state laws or engages in misleading, deceptive practices, or fraud. And then lastly, I will just mention what's called closed school discharge. So certain instances, the closure of your school may result in the discharge of your loans or the release of your obligation to pay for those loans. You may be eligible for a discharge if your school closes while you're enrolled and you're unable to complete the program. or if your school closes shortly after you withdrew. Again, a lot of these are kind of situational programs, and so if you have any questions about that, would recommend you reach out to somebody. And you can check out all these options at studentaid.gov. And I just want to emphasize for these as well, it's kind of the same thing as the last slide, whereas these discharge programs are going to be tax exempt on a federal level, but that's going to vary based on your state. So your state might have a different tax law that's going to require certain tax requirements on those. And with that, I'm going to turn it over to Arwen Thoman from Massachusetts.
Thanks, Luke. I just wanted to clarify one point, which is that PS public service loan forgiveness is generally not treated as taxable income on federal tax returns, but that could vary by state. Income-driven repayment forgiveness is now generally treated as taxable income for federal tax purposes and may also be treated as taxable in your state. But I'm here now to talk about the different repayment plans that you can switch to based on your repayment goal. So next slide, please. Broadly speaking, for those of you who are finished taking out your loans, there are three main options. First, as we've talked about, you can do nothing and you'll be put on a standard plan. Second, you can switch to another income-driven plan. And third, you could switch into an extended and/or graduated plan. Next slide. Here is sort of an overview of all of the repayment plans. If your goal is to pay off your federal loans quickly, as Scott mentioned, choosing the standard plan often makes sense. This plan has level monthly payments, but the term length can be anywhere from 10 to 30 years, depending on whether you've consolidated. You may need to make extra payments if you want to pay off your loans quickly and you have one of these longer terms. If you're looking for the plan with the lowest monthly payment, it really could end up being any one of these plans. It depends on your income, your family size, your loan type, when you took out your loans, and what your balance is. We'll talk about how to find out what your payments would be under each plan later on. If you're planning to pursue public service loan forgiveness or income-driven repayment forgiveness, in nearly all cases, you will need to choose one of the plans that are highlighted here in green. These are the income-driven plans. Keep in mind that the ICR plan and the pay plan will be phased out by July 1st of 2028. While you can potentially choose one of these plans for now, you will have to switch to another income-driven plan down the line. Next slide, please. Now, if you're done taking out federal student loans, including doing any consolidating, we're just highlighting here on this slide that you will not have access to the new tiered standard plan. That's only going to be available if you take out loans or consolidate after July 1st of 2026. Next slide. We do want to caution you, though, that your repayment plan options are going to be far more limited if you take out any federal student loans after July 1st of 2026. This includes consolidation loans that fund after July 1st of this year. In this scenario, you would only have access to the newest income-driven repayment plan, called RAP, and the new tiered standard plan. And if you have Parent Plus loans, these are loans that parents take out for their kids, you'd only have access to the new tiered standard plan. We're going to talk about these plans more later on in the presentation. Next, please. Okay, so if you don't choose another plan and all of your loans were taken out before July 1st of this year, you're going to be put on the old standard plan, and your payments will probably be higher than what they were in SAVE. For unconsolidated loans, the standard plan has a 10-year term, as I said. But for consolidation loans, the standard plan has a term between 10 and 30 years, depending on the loan's original balance, as you can see here in this table. Standard plan payments on consolidation loans do not count toward PSLF or income-driven repayment forgiveness. This is an important point because many people have consolidated their loans and have consolidation standard plans, and we often see people sort of mistakenly believe that these payments will count toward PSLF and income-driven repayment forgiveness, and that is simply not the case. You can find out what your standard plan payment amount is by using the U.S. Department of Education's loan simulator while logged into your studentaid.gov account. But if you're seeing a number that's, a really high standard plan payment figure, you may want to actually call your servicer just to make sure that it's actually correct. Next slide, please. For those of you who do end up taking loans after July 1st of this year, the only standard plan available to you will be the new tiered standard plan. And that's true even for your older loans, which is a little confusing. The term length here for the new tiered standard plan is based on the total outstanding direct loan principal balance at the time your loans enter repayment. Once again, tiered standard plans do not count toward public service loan forgiveness. They don't count toward forgiveness under any of the older income-driven repayment plans, including IBR, ICR, or PAY, but they do count toward forgiveness under the newest income-driven repayment plan called RAP, provided that you make the payments on time. Now I'm going to pass it over to my colleague, Erica Harmon of Massachusetts, to tell you more about income-driven repayment plans.
Thanks, Aaron. So rather than waiting to be placed in the standard plan, you may want to switch to another income-driven plan, especially if you are pursuing income-driven plan forgiveness or public service loan forgiveness. Unfortunately, the payments under these plans may be higher than your SAVE payments, but they could still be lower than your other options. The older income-driven repayment plans are income-based repayment, or IBR, income contingent repayment, or ICR, and pay-as-you-earn, or PAY. And these plans offer the possibility of forgiveness after 20 or 25 years, depending on the plan and when you took out your loans. And they use your income and family size to calculate your payments. Typically, the income used to calculate your payment is from your most recent tax return. Though, if your income has gone down since your most recent tax return, you can submit alternative documentation of income, and you can do that sort of in the middle of the term. If you're married and you file your taxes jointly with your spouse's income will be included in the calculation. And if you're married and your spouse doesn't have federal student loans, you may want to explore filing your taxes separately. So your payments are calculated using only your income rather than your combined income. You can find out your eligibility and what your monthly payments would be under these plans by starting an online application at studentaid.gov/IDR and allowing the U.S. Department of Education to link to your most recent tax return. So before looking at these plans more closely, keep in mind that if you take out any federal loans or consolidate on or after July 1st, you won't be eligible for any of these older plans. Next slide. So here's an overview of the older income-driven plans. Each plan calculates your monthly payment differently. We want to highlight that there are two versions of the IBR plan. The old IBR has higher payments and a 25-year forgiveness timeline. The new IBR has lower payments and a 20-year forgiveness timeline. The new IBR is available if you took out all of your loans after July 1st, 2014. You could also be eligible if you paid off loans taken before that date, before taking out new loans after July 1st of 2014. So that could happen, for example, if you paid off your undergrad loans before taking out grad school loans or before taking out Parent Plus loans for your kids. Unlike the other plans, the ICR plan considers your loan balance in the calculation. It's usually more expensive unless you have a low loan balance. The pay-as-you-earn plan also has eligibility requirements. First, you must not have had any loans outstanding as of October 1st, 2007. Second, you must have taken out a new loan on or after October 1st of 2011. And third, your pay payments must be less than what you would pay on a 10-year standard plan. Parent Plus loans that have not been consolidated are not eligible for any of these plans. But if your Parent Plus loans were consolidated into a direct consolidation loan, and that consolidation loan was dispersed before July 1st of this year, you can access some of these plans. We'll talk more about Parent Plus loans later in the presentation. Next slide. RAP, which stands for Repayment Assistance Plan, is a new income-driven plan that was created by recent legislation, and it should be available in July. Payments under RAP will be higher than SAVE. RAP payments are calculated as a percentage of your income minus $50 for each of your dependents. Depending on your income, the lowest possible monthly payment is $10, whereas under those older income-driven plans, payments could be $0 if your income is low enough. The forgiveness timeline for RAP is 30 years rather than 20 or 25 under the older income-driven plans. A payment in RAP has to be made on time to count toward the 30-year forgiveness timeline or public service loan forgiveness. But despite these drawbacks, RAP may provide helpful principal and interest subsidies for some people. If your RAP payment doesn't cover interest and reduce your principal by at least $50, a subsidy payment will be applied to ensure that your interest gets paid and your balance goes down by $50 each month. For some people, these subsidies can be very valuable, but these benefits won't help you if your RAP payment is enough to both pay your monthly accrued interest and reduce your balance by at least $50 a month. In comparison, the older income-driven plans offer less generous subsidies or no subsidies. This can lead to ballooning loan balances if your payment doesn't cover the accruing interest on your loans each month. We also want to note that RAP typically offers lower payments than the old IBR plan. That's the IBR plan available if you took out your loans prior to July 2014. So if you took out loans before July 2014, you may want to consider enrolling in RAP rather than IBR. You can estimate your payments under RAP at mass.gov/AGO/RAP. We do want to note Parent Plus loans are not eligible for RAP at all, even if they've been consolidated. Something else we want to highlight is that payments you make in RAP will not count towards forgiveness under the older income-driven plans, so IBR, ICR, and PAY. This means if you're pursuing income-driven repayment forgiveness, if you choose RAP, you will not be able to switch back to another plan without losing the progress towards forgiveness you made while paying in RAP. This is different from all the other income-driven plans. In the older plans, you carry your qualifying payments with you when you switch income-driven plans. So that concludes the review of the income-driven repayment plans. I'll now pass it to Amy Hennon from Maryland.
Thank you, Erica. I want to take the opportunity now to highlight an additional option that may be available and may appeal to some that are currently in repayment, and those are the extended or graduated plans. These may be helpful if you aren't eligible for income-driven repayment or can't afford your income-driven repayment plan. These may have higher total loan costs than the standard plan. They may offer lower payments than the standard plan, but they don't typically count towards public service loan forgiveness or income-driven repayment forgiveness. Next slide, please. The two plans I'm going to highlight are the graduated repayment plan, where payments start lower and automatically increase every 2 years. The lower initial payments can accommodate slowly increasing salaries. However, the payments, as they increase over time, may become unaffordable, and it is likely that you would pay a higher total loan cost at the conclusion of repayment. The extended repayment plan lowers monthly payments by spreading it out up to 25 years and requires a minimum threshold of debt of $30,000, and it can be combined with the graduated repayment plan. This may be appealing for folks who are looking for the lowest possible monthly payments towards large balances. And however, the long repayment term can result in significantly higher total interest paid over the life of the loan. And of course, it's really important to note that these plans are only available if all of your loans, including any consolidations, were taken out before July 1st, 2026. Next slide, please. I want to take this opportunity to highlight what is available to borrowers with Parent Plus loans. The landscape is rather complicated depending on what the status of your Parent Plus loan is. A Parent Plus loan is one that is taken out by a parent or guardian for a dependent student. If you don't have these loans, you can certainly tune out. But this chart shows the repayment options that you have or will have depending on whether you have consolidated a Parent Plus loan, when you consolidated that loan, and whether you take out any more loans after July 1st, including any consolidation disbursement. Starting at the top, if you previously consolidated a Parent Plus loan before July 1st and don't take out any new loans, you can then repay your consolidation loan in the IBR plan after making at least one payment in the ICR plan. You can also access existing standard, graduated, and extended plans. If you didn't apply to consolidate and it's just if you apply to consolidate and it's dispersed after July 1st, you will only have access to the tiered standard plan. If you did not consolidate prior to July 1st and do not take out any new plans after that date, you will have access to the old standard plan, extended, and graduated plans. As a reminder, taking out any more loans after July 1st will limit any Parent Plus loans or any consolidation taints that Parent Plus loan previously taken out as far as the new standard plan. And now I will turn it over to Lilia De La Torre from Illinois.
Thanks, Amy. Now, let's move on to talk about other options that you can explore in case that the payment plans that were presented to you are unaffordable. Here in this section, we're going to be talking about consolidation, temporary relief, refinancing, and what happens if you stop paying your loans. Next slide, please. So first, let's talk about consolidation. Consolidation is a process that allows you to combine one or more federal student loans into a new federal loan. More specifically, it's a process of converting older loans like Fell or Perkins into a direct loan consolidation, or combining multiple direct loans into a single direct consolidation loan. You can consolidate your loans by applying online at studentaid.gov, and it's free. And for purposes of this section, consolidation refers to consolidation that occurs on or after July 1st of 2026, given that we're so close to the deadline, and it typically takes 30 to 60 days to process consolidation. So who may benefit from consolidation going forward? If you have federal Perkins or federal program loans and you want to pursue PSLF, consolidation may be a good option. If you're also pursuing PSLF and you want to have your loans, for your loans to have the same forgiveness timeline, consolidating can help you achieve that. Please note that for purposes of PSLF, your new direct consolidation loan will receive an average of the PSLF qualifying payment counts on the loans consolidated, weighted based on their balances and time in repayment with an eligible employer. You can try EdCap New York's weighted average calculator to see what that would look like. Here's a tip. Make sure to certify any qualifying employment before you consolidate. This will help ensure that the weighted average is correctly applied. Next slide, please. Here are some additional benefits to consolidation. If you are in default and you've exhausted all of your rehabilitation options, consolidating can help you get you out of default. If you are not pursuing public service loan forgiveness and the income-driven repayment plans are not affordable, but you want to lower your monthly payment and you owe between $25,000 and $30,000, or you have significantly less than 10 years left in your repayment term, again, consolidation here may be a good option. But I would encourage everyone in this situation to reach out to your state ombudsman to see what may be the best option for you. Next slide, please. Now let's talk about some of the downsides to consolidation, and there are quite a few. Here are some. If you consolidate now, you will only have, as my other co-panelists shared before, you will only have access to the new tier standard plan and the REP payment plan, even for other loans that you did not include in that consolidation, with a few exceptions. If your consolidation includes any Parent Plus loans or an earlier consolidation that included a Parent Plus loan, you will only have access to the Tier Standard plan. And remember, the Tier Standard plan does not count towards PSLF, so you will be blocked from pursuing PSLF on those loans. Next slide, please. Here are a few more downsides to consolidating your loans going forward. Your principal balance will increase because any unpaid interest will be capitalized or added to your loan principal. You may also spend longer in repayment and pay more interest over time. If you consolidate all your loans into a single consolidation, note that you will not be able to consolidate to get out of default in the future. So while you can initially consolidate to get out of default, this is the downside of consolidating all loans into one and then not being able to do it in the future again. And then also note that payment count for income-driven repayment forgiveness will restart at 0 once you consolidate. And now I will turn it over to Evelyn Castro from Nevada.
Thank you, Lilia. Good afternoon, everyone. In the next few slides, I'll be covering deferment and forbearance, including a few important updates regarding them, as well as things to keep in mind if considering refinancing federal student loans. Before discussing deferment and forbearance, it's important to emphasize that these options should generally be viewed as a last resort. Borrowers should first explore all available repayment options, the ones that we just spoke about, particularly income-driven repayment plans, because these programs can often provide affordable monthly payments while keeping borrowers on track toward forgiveness and repayment. Deferment and forbearance are designed to serve as temporary emergency relief when borrowers are facing financial hardship or unexpected life circumstances and have exhausted their other repayment options. Although similar, the primary difference between the two is how interest accrues. These tools can help borrowers avoid delinquency or default by temporarily pausing their payments. However, borrowers should understand the long-term consequences. During certain types of deferment, interest does not accrue only on subsidized loans, but during forbearance, interest accrues on all types of loans. Over time, this can substantially increase the total amount repaid on your student loans. In addition, periods spent in deferment or forbearance generally do not count towards loan forgiveness programs, including public service loan forgiveness, except in certain limited circumstances relative to military, service-based, economic hardship, cancer treatment, or administrative deferments or forbearances. We will be providing a copy of this presentation to participants, and therefore you will be able to review the link included on this slide for additional information and specific qualifying circumstances. For all these reasons mentioned on the slide, borrowers should view deferment and forbearance as short-term emergency measures rather than long-term repayment strategies. Next slide, please. This slide highlights some important changes to deferment and forbearance under the One Big Beautiful Bill Act that will primarily affect new borrowers beginning July 1st, 2027. First, new direct loan and Parent Plus borrowers will have fewer options for pausing their payments. One significant change is that borrowers will be limited to a maximum of 9 months of forbearance within a 2-year period, which differs from previous rules since under current rules, borrowers could often receive forbearance for up to 12 months at a time, in some cases renew it for multiple consecutive years. Another major change is the elimination of economic hardship and unemployment deferments for new loans dispersed on or after July 1st, 2027. These deferments have been available to borrowers experiencing significant financial hardship based on income or the receipt of certain public assistance benefits, or who are unemployed or unable to find full-time employment while actively seeking work. Borrowers with loans dispersed before July 1st, 2027 may still qualify for the economic hardship or unemployment deferments under the existing rules if they meet eligibility requirements. These changes reflect a broader shift away from long-term payment pauses and place greater emphasis on borrowers remaining in active repayment. As a result, it will become increasingly important for borrowers to understand their repayment options early and seek assistance before they experience financial distress. Next slide, please. Next slide. Thank you. As we just discussed, recent changes under the One Big Beautiful Bill Act will limit some of the safety nets available to borrowers, including certain deferment and forbearance options. When borrowers experience financial hardship or are looking to lower monthly payments, they may start considering refinancing their federal student loans into the private market. In fact, some borrowers typically confuse refinancing with consolidation and sometimes will use the terms interchangeably. However, these are two very different processes with very different consequences. Now, before discussing this option, I want to acknowledge that as student loan ombudspersons, we do not typically recommend refinancing federal student loans into the private loans. We recognize that this option exists and may be appropriate in very limited situations, but borrowers need to proceed with extreme caution because the risks can be significant. The most important message on this slide is the warning at the very top. Refinancing federal loans into private loans is irreversible. Once federal loans are refinanced, borrowers permanently lose valuable federal benefits, including income-driven repayment plans, deferment and forbearance protections, loan forgiveness opportunities such as PSLF, hardship protections, and access to any future federal relief programs. In addition, private loans often come with their own challenges. Borrowers may need a cosigner to qualify. The lowest interest rates are typically reserved for those with excellent credit histories and high credit scores. In my professional experience, I have seen private lenders charge interest rates as high as 17%. Many private lenders also offer variable interest rates, meaning payments can increase over time. While refinancing may offer benefits to some borrowers, such as a lower interest rate or different repayment terms, it is critical that borrowers carefully weigh the pros and cons associated to their individual circumstances and thoroughly read the loan terms before signing. Again, I want to emphasize that once a borrower refinances federal loans into the private market, there is no option to convert those loans back into federal loans. To continue building on these important topics, I'd now like to turn it over to Selena Damian, California's Student Loan Servicing Ombudsperson.
Thank you, Evelyn. Good afternoon, everyone. So what happens if you stop paying your loans? What happens if you exhaust your forbearance, your deferment, if you get overwhelmed and ignore payments? What happens if you miss payment on you have several loans and you miss a payment on one of your loans? The consequences could be severe. And I want to discuss delinquency and default today and steps to and explain what each one of those are and what happens if you do get to that point. When you miss your first payment or don't make your full monthly payment, you will start receiving past due notices from your servicer. It is crucial that you do not ignore these letters, emails, any of the correspondence, and that you don't miss any deadlines. So it is very important that you keep your contact information updated with your servicer. Not knowing or not being aware does not relieve you from owing the balances and could still put you in your loan in delinquency status. So not knowing or not being aware will not be an excuse to get you out of delinquency. Immediately contact your student loan servicer. They will be able to help you understand your options and then discuss those options with you. Currently, collection activity for defaulted loans is paused, but they may resume at any time. We don't know when, but just because everything is at a standstill does not mean that they will not resume with collection activities. As you've heard throughout the webinar, you do have options. We will discuss more after my section as well, but you do have options to stay out of delinquency. Next, please. So when do you become delinquent on federal student loans? You become delinquent after your first missed payment. Again, you will be notified by your servicer. If your delinquency is not resolved within 90 days, your delinquency will be reported to national credit bureaus. your credit score will take a hit, and it may affect you in other ways if you are trying to make other big purchases. If the Sorry, the loan will remain delinquent until you pay your past due balance, you apply for an income-driven repayment plan, or you request a retroactive forbearance. This can be done by calling your student loan servicer. Not resolving a delinquency can lead to default, which can also lead to the harsher consequences of collections. Next, please. So if your loan is in delinquency and you don't resolve it and a payment is not made within 270 days, it goes into default and the unpaid balance and interest must be made in full. This is called acceleration. After 360 days, the loan is moved to the federal default servicer, which is the default resolution group. So how can you resolve the default? So you've been in delinquency, haven't made a payment for 9 months, your loan has been moved to default. There are 3 ways that you can resolve it. You can pay the balance in full, which usually is not reasonable for many borrowers. You can apply to consolidate the defaulted loan. You heard about consolidation and the pros and cons with that. To consolidate a defaulted student loan, you agree to repay the new direct consolidation loan under an IDR plan. Remember, if you consolidate moving forward, you will only have access to the repayment assistance plan, or you can make 3 consecutive voluntary on-time payments before you consolidate the loan. So again, remember, consolidating the loan will extend your loan period, but it will increase the overall balance of your loan. That is one option. You can also rehabilitate your loans. Through rehabilitation, the borrower enters into a rehabilitation agreement, and you agree in writing to make 9 voluntary, reasonable, and affordable monthly payments during a period of 10 consecutive months. This is currently just a one-time opportunity. So if you have rehabilitated your loans before and completed a rehabilitation agreement, you do not have the option to do it twice. However, starting July 1st, 2027, you are able to rehabilitate a loan twice. But currently, consolidation and rehabilitation are the most common ways to clear a default. Also, if you consolidate your loan, your default is not removed from your credit report. However, if you rehabilitate your loan, you go through the agreement, complete the 9 months, the default record will be removed from your credit report. So that's one of the differences between those two. There is also a way where you can submit a request for review, or you can object to the debt, but that's further down if you're in collections, and it's more of a difficult process done through the default resolution group. But consolidation and rehabilitation are going to be the most common options. Default resolution group will help you understand what those options are. And again, very important not to miss deadlines, to really understand those options, because if you do not resolve a default, there are very harsh consequences that the department will take to collect their money, basically. You are subject to tax refund interception or offset through the Treasury offset program. You are subject to administrative wage garnishments, where up to 15% of wages may be garnished. You are also subject to Social Security offset through the TOP program or Treasury offset program. You will also no longer be able to receive deferment or forbearance or have access to certain income-driven repayment plans. If you are planning to go back to school, you will lose eligibility for additional federal student aid. So you may not be able to attend school. You will have to resolve that default before going back if you're planning on restarting your education. Of course, the default is reported to credit bureaus, which can stay on your credit report for up to 7 years. So again, it can have long-term consequences in addition to the wage, the federal benefit offset. And one thing to remember is that there is no statute of limitation for defaulted student loans, and the Department of Education will continue attempting to collect the loan and could even sue the borrower in some cases, and could add collection cost and legal fees. But as stated, we've discussed the many options, and just keep in touch with your servicer. Pay attention to the communication. The options may seem overwhelming. It may seem a little confusing, but it will be more confusing. You will have more limited options if your loan is placed in default. So hopefully you obtain some great information today that will help you stay out of delinquency and default. Now I will pass it over to Jessie Myers, our Washington, D.C. Ombudsperson.
Amazing. Thank you, Selena. Hi, everyone. We've covered a lot of content today. We've covered payment plan changes, forgiveness options, repayment strategies. We wanted to end with some action steps and tools to move forward. Next slide, please. So where do you begin? Step one, take some time to reflect on your repayment goals. We discussed strategies related to minimizing your payment and pursuing forgiveness compared to paying off your debt as quickly as possible. There's no right or wrong answer here. Strongly consider your forgiveness options at this stage. Think through pursuing options like income-driven repayment or IDR and public service loan forgiveness or PSLF. Some places to start. So we included tips and tools towards the bottom of these action step slides. So if you haven't logged into studentaid.gov, do so. Make sure your contact information is up to date. On the studentaid.gov website, you can track your PSLF progress, certify PSLF employment, apply to income-driven repayment, and apply to different discharge programs. So anything ed administered will be through this website. Additionally, be sure to log into your servicer account. And here you can set up payments, so you can set up things like auto pay and receive an interest rate incentive in doing so. Our friends at EdCap put together a really helpful repayment plan strategy guide. This is the second bullet point under helpful tips. We covered a lot of this today. Feel free to also take a look here as you're thinking through how these strategies and how these changes apply to you individually. We also encourage you to review forgiveness types. We, conducted an overview today of programs like PSLF, borrower defense, closed school discharge. If you go to this link that we have here, you can get a little bit better sense of what some of the eligibility requirements are and what next steps there would be in terms of applying. We also want to highlight if you are a government or 501c3 employee working on average 30 or more hours per week, currently or any time since October 2007 to present, be sure to certify that employment using the PSLF help tool linked here. Next slide, please. Okay, step two. Estimate your monthly payments. How do you do this? One way is you can start an IDR application at studentaid.gov/IDR. You will have the option to authorize connection to your IRS federal tax information. And in doing so, you'll be able to see your IDR plan eligibility, your monthly payments, and forgiveness progress. FSA also has a loan simulator tool that you can use. Please note that if you borrowed any loans prior to July 1, 2014, your payment that will be listed under income-based repayment may actually be higher than what's listed there. So if you have concerns about that, you can confirm by looking at your loan history, seeing when you first borrowed, or by calling your servicer. EdCap also has a really helpful repayment plan calculator, which also includes estimates for the new RAP plan. So be sure to check that out. Additionally, we also wanted to flag here to assess your progress towards income-driven repayment forgiveness, particularly given the one-time account adjustment that Ed instituted or the Department of Education instituted to provide retroactive credit towards forgiveness. This adjustment was completed in late 2024. I do want to note that some ombuds offices have heard from borrowers related to concerns related to this account adjustment and making sure that all of their qualifying time was accurately counted. So we really want to encourage borrowers to review the account adjustment page, which we've linked here, so you can understand your eligibility requirements. And if you aren't sure where you're at in terms of PSLF progress or IDR progress, you can log into studentaid.gov. And then when you're logged into your account, you can copy and paste this link that we have here, this /app/API, into that same browser. It's important that you're logged into your account when you do so. What this will show you is it will show you an output with all of your PSLF and IDR progress. It's going to look really messy once you enter the link. There should be an option that says pretty print with a check mark. Be sure to check that. If you face any issues with that, I've seen better success in using Google Chrome. What this provides you is a count of what your student aid account shows you of where you are in terms of your progress for both income-driven repayment and public service loan forgiveness. This is typically most handy for the income-driven repayment progress since counters were removed sometime last year. You can see a neater version of your PSLF progress on your studentaid.gov account. Okay, next slide, please. So step 3, applying to a new repayment plan. You've learned a lot in this webinar. You've thought through your strategy, you've estimated your payment. Now it's time to actually apply to the plan that best fits your needs, whatever those are. For faster processing time, if you're applying to income-driven repayment, we recommend going to studentaid.gov/IDR and applying. You can also call your servicer if you're interested in enrolling in the standard, extended, or graduated plans. Remember, these are the fixed repayment plans that we talked about. We also included a PDF application here for the old standard plans, extended, or graduated plans. Save borrowers who do not take any action will be placed in the standard plan 90 days after the date of their servicer notification letter. And finally, I know we talked a bit about this on the last slide, but we really do see faster processing time when folks opt into the IRS federal tax information retrieval. So if you're concerned about, getting into repayment, starting your progress towards forgiveness, whether that's income-driven repayment or PSLF, we highly recommend using this tool. So with that, I'll pass it over to Amber Hay from Washington State.
Thanks, Jesse. All right, folks, I'm the last presenter here, so bear with us. We've got just a few more minutes. And if you need to leave, feel free to come back and you'll get the recording and you can catch up on these last few minutes. So, all right, so action step 4. After applying for your new repayment plan, please closely monitor your student loan servicer account. Check the electronic inbox in that account for important communications. This may include notification of temporary processing forbearance, for instance. That's placed for up to 60 days if you've applied for an IDR plan and that application isn't processed quickly. You should receive written communication of your new monthly payment under the payment plan that you applied for, as well as information about your next due date. Be sure to verify that the plan is correct on that communication that you receive. We have heard of borrowers first getting an incorrect notice that sort of broadly identifies IDR as the payment plan with maybe an incorrect monthly payment amount. So if you receive that notice that's got that kind of generic IDR, it may not be accurate. If the estimates that you get or the amount that you get on that notice is significantly different than what you estimated on the different calculators, or you think is otherwise incorrect, please call your servicer to follow up. Finally, we recommend that you sign up for auto pay to ensure automatic on-time payments. This helps to avoid that delinquency that Selena was talking about and ensures that your IDR payments can qualify for PSLF or IDR forgiveness. Normally, all borrowers enrolled in autopay receive a 0.25 interest rate reduction. However, the Department of Education just announced last week that they are increasing this interest rate reduction to 1% for borrowers who are enrolled in autopay by September 30th, 2026. This 1% rate reduction will be in place for nearly 2 years until June 30th, 2028, and will apply to borrowers with loans disbursed on or after July 1, 2012. Our fifth and final recommended action step is to review your repayment strategy and to recertify your income annually if you're on an IDR plan using the IDR application. You can sign up for automatic IDR recertification by authorizing the IRS information retrieval when you submit that IDR application, or by changing the settings in your federal student aid account at studentaid.gov. Missing your IDR recertification can result in significantly higher monthly payments and potentially interest capitalization, depending on which plan that you're in. And note that you don't have to wait a year to recertify your IDR plan. If your circumstances change in a way that would result in a lower monthly payment, you can certify your plan early. So for instance, if your family size changes or your income decreases dramatically. With how much change has occurred, it is recommended that you save copies of all the communication and notices that you receive about your student loans. That's just a good rule of thumb at all times for your student loans. All right, we know that there's a lot of stress and anxiety surrounding the end of the SAVE plan. This presentation was aimed to help you understand what different options are available to you as you navigate this time of decision making. We know that we covered a lot of information and it can be a bit overwhelming. So take a breath. You will be able to watch this recording back, view the slides, and access all of the links we've included. These resources and tools will help you to take control of your student loans. There isn't any one right answer or approach for leaving the forbearance that's right. It all really just depends on your goals, your repayment strategy, and your financial situation. So whatever decision you make regarding switching repayment plans, remember that your repayment plan is simply a tool, not a permanent decision. You can always revisit your options when your circumstances change to determine if that plan still works best for you. As we wrap up, we also encourage you to share your stories and your concerns about your own student loan situation and your experience with the student loan system with your congressional representatives. Your own self-advocacy can help shape future student loan borrowing and lawmaking in the future. Finally, we do want to let you know that we have all of our all our presenters' contact information in these slides, as well as links to other state advocates and ombudspersons who weren't able to join us today. Please reach out to us if you encounter difficulties or have further questions. If your state doesn't have a student loan advocate or ombudsperson, you may reach out to Federal Student Aid, the Consumer Financial Protection Bureau, and your congressional representatives to file complaints and seek assistance. Thank you so much for joining us today. Please look out for our follow-up email with the recording and slides within the next week, and please have a great rest of your day.